IVM.
Hey, so welcome to Shunya One, episode 29. We have Aseem Khare with us today, who's an entrepreneur who's seen the rise and fall of Powai Valley through 2015 and 16. We're going to talk about that, go deep into what kind of challenges you have in the home services sector, and of course, what it's like to shut down a VC-funded startup. So we have an interesting show for you. But a quick callback to some great stats we have and feedback we have on our previous episode with Ankita.
That episode went off really well, and on our Slack channel, Arpit Arora really liked the episode. He had a comment saying, "Loved the episode. Ankita T was awesome. It was great to hear your story. Was particularly intrigued by the online and offline behavior aspect of the consumers. Also, your views on women entrepreneurship and workplace behavior were very insightful." And he bought a Zomato Gold subscription as well. So he was asking if he's screwed. I don't think he is necessarily screwed because Zomato's a pretty cool company that way. But hey, we'll find out soon enough. And we had another interesting comment from VS Vivek where he also really enjoyed the episode. This is the best episode for me so far because the discussion was about multiple facets of the ecosystem that is required before it matures. And thank you to all three of you. So thank you, Ankita. That was a great episode and we were glad to get the feedback.
Exactly. I'm really happy.
I think we got some feedback on Twitter as well, right?
Yeah, I think, exactly. People like Samir, Namit, and of course Vijay Shekhar even posted about the episode.
Yeah, that was exciting.
So we hope to have all these fine gentlemen on the show talking about the stuff they've done soon enough. And I'm happy with the feedback we're getting. It's great. Let more stories be told and topics we discussed. And of course, someone just also posted a video about how to do podcasts in the random section of the Slack channel. So
really?
Maybe I need to learn something.
Well, no, but dude, seriously, that's really the hint that they want to give us, man. Seriously, how to do a podcast? Come on, man. Who was that? Guys, on the Slack channel? No,
but
Pinaki, what are you talking about, man? You don't need to tell us how to do podcasts. We know how to do podcasts. At least the technical part of it, which is what they're explaining here.
Yeah. So no, if it's for me, then I hope to get better, man. I hope.
Well, we all hope to get better. But is this passive aggressive or is this helpful? I don't know.
Let's get on with our show and we'll find out. All right, so today we have Aseem Khare, the CEO at Adonis Electronics, which I will ask you about what Adonis really does. But in the past, you've actually been an entrepreneur and you were the founder of TaskBob and another company called Shock.
Yeah.
And before that, you were starting out in equity financing in Nomura.
Yeah.
But obviously, you've been a major part of the Bombay ecosystem while in TaskBob. So I think there's a lot we have to hear from you. Welcome to the show, Aseem.
Thanks a lot. My pleasure to join in.
Yes, and I know now you're back in the corporate life, so it's difficult to get hold of you because you're doing corporate hours.
Yep, Saturday recording once again.
Yeah, unlike, of course, startup hours, which never end.
Yeah.
So I think tell us about how life has been and, of course, where the whole story where it started and where it's come to.
Yeah. So I graduated from IIT in 2007. And then I did engineering, but like most of us engineers we really don't like engineering as much as we should. And
it's a life experience,
yeah,
more than education.
Absolutely. So I did chemical engineering, and in second, third year, I knew that I cannot do chemical engineering. Mm-hmm. And then I joined Lehman Brothers. It was more of maths which got me pulled into Lehman Brothers because I liked solving math problems, and it was in equity derivatives that I was working on in Lehman. So pretty complex mathematical stuff. It was exciting. We for 1 year we were at Lehman Brothers, and then Lehman Brothers got bankrupt.
Right.
Then Nomura bought Lehman Brothers. So I moved from equity derivatives to equity structuring to equity strategy in Lehman Brothers and Nomura. But then over the course of 6 years, then I realized that I was not really creating any impact. Mm-hmm. And that's why I started off with my first company called Shock, SHAUKK. So it was a platform where like-minded people in the same vicinity could interact.
Interesting.
I was playing football. I used to play football. I even play now, but I couldn't find footballers around me. I used to sing, but I couldn't find a drummer around me. So I thought by way of this platform, I'll be able to find people, and I'm sure there will be many such people facing the same issue.
What year was this?
This was in 2013.
So was this built on top of another social network, or was this your own kind of?
It was an own kind of a social network. It started off from a website.
Okay.
And then we got incubated at TIE.
Okay.
And then there we understood that probably an app will make more sense.
Right.
So it was more like WhatsApp in some ways at that time. WhatsApp was also coming in at that time.
Right.
But it was more like threaded chats
Okay.
over and above what WhatsApp is.
Right.
It was interesting. The acquisition was happening pretty well, but engagement wasn't happening. And we went deeper into it, spoke with our customers, and we realized that people in India don't really have the time to pursue their passion continuously. So we faced two big issues. One is that people would actually go on the field and then start creating WhatsApp groups and go out of our platform. That was problem number one.
Right.
But the bigger problem was that in those WhatsApp groups also, I would see that earlier on there would be 20-25 people on the field, and then later on they would die down to 4 or 5 people on the field.
Right.
So the challenge is that people really don't have the time to pursue their passion that much. That's when we spoke with our customers and then started off with TaskBob.
Okay.
So TaskBob was...
what was the
So
same
it was an
translation?
evolution of the same company?
It was an evolution of the same company, but so at that time we clearly knew that Shock isn't working out.
Right.
And then we thought that what next? We listed down like 4 or 5 issues. One of them was just an offshoot of TaskBob, of Shock in a way.
Okay.
But there were some 3-4 other ideas as well. One of them being that of TaskBob. There were 2-3 other ideas.
Right.
And then finally, given what we believed in more, what our team's strengths were, we decided we should go ahead with TaskBob.
So I'll just say I used to love TaskBob. I used to call for drivers from it all the time. But yeah, it was just great. I used to love it when it was there.
Thanks, man. It really
And
still makes me feel nice.
I think it also was. I think you all kicked off the whole home services segment in a lot of ways, right?
Yeah.
Because it was obviously underserved. It, I think, still is fairly underserved. And it before it became a huge. The hype around it actually started. I think what you were doing was a lot of hard work on the ground, right? In terms of organizing this sector.
Absolutely.
So your understanding of how people get organized themselves in Shock, did that ever? Did you think what made you focus on the sector?
So it was interesting because initially when we started this off, we did not know how to start home services. Shock was a completely different kind of a startup. It was networking, it was events driven, and this was more completely hands-on, execution focused. But on day one itself, when we spoke with a lot of customers, we knew what the problems were. So we went into understanding what is it that really troubles people in getting home services. It was timeliness, it was pricing, it was quality. So from day one, we were very clear what our vision was and what we wanted to solve for. And from day one, we wanted to solve these issues. So everything was reverse engineered from solving these 3 things. So from day one, we gave our service providers a t-shirt to wear and standardized the rate card before even starting with the service, because we were solving how to standardize prices.
Right.
We gave an urgent delivery. So in 1 hour, if you click on the TaskBob app, then in 1 hour, you'll get a service provider. That was our initial
USP.
USP, exactly. Yeah. So we solved for these 3-4 things right from the start towards till the very end. So we were pretty clear that was what we wanted to reverse engineer, and everything came back from it. So not really that Shock's experience helped us in building TaskBob, but it at least told us that you should speak with your customers more and understand what they really want, and then that helped us to do what we wanted to do.
Right. And again, this was early in the, I would say, building of the ecosystem in Bombay, right? Powai, you're also Powai based, so you were part of the Powai Valley initial bunch of startups. And see, whatever said and done, I think Powai definitely had its fair share of starts of a lot of companies. Some of them very big even today, right?
Yeah.
And a lot of them which have either died out or pivoted and so on, or moved to Bangalore, as we know. But what was the I would say the ecosystem, just to understand from your perspective, which actually helped get these things off the ground, or helped you take these bold steps of, let's say, go into this new sector, let's attack this. What was really prevailing back then, or even now? Do you think it does?
So I see there's a big change now than how it was at that time.
Right.
That time, I agree, Powai Valley was really booming, and the effects that it had were many, right? So for one, we would be networking with a lot of entrepreneurs within Powai. Starbucks used to be Starbucks Aromas in Powai. They would be always occupied with entrepreneurs, and we could go and meet any entrepreneur, understand what they are doing, what are the challenges that they are facing. That really helped us a lot, because we would know that there are many people who are like us. They are facing some challenges, one or the other. Number one. Number two, because of this network and because of this ecosystem, finding people and creating a team was much easier in that time, because there were a lot of people, and because of this hype, there were a lot of people who wanted to join startups in Powai itself.
Even from IITs.
Even from IITs, even from IIMs for that matter. And that entire community around joining startups was pretty big during that time. Third is, from a customer's point of view also, it was very helpful, because because of these many startups creating platforms for the consumer, the customers were right up the curve in terms of trying out new things.
Right. They were early adopters of
exactly.
whatever you gave them.
Exactly. So the entire Powai Valley ecosystem would really adopt any new product which would come in the market. They would give the feedback. They would be ready to talk to the founders.
Right.
So that really helped us and gave a quick start, basically. So it was much like Bangalore at that time. It was moving fast. The consumers were of a particular age group, trying a lot of new things. So that was pretty different. Now it's a little different because of the high cost of living. Not a lot of entrepreneurs are starting off in Powai. It's not easy to find good members for your team within Powai. So it's a little difficult now.
Is that Powai or is that Bombay?
Yeah, it's more or less
Bombay.
Bombay. Yeah.
Yeah, but how different has it become? Just on the points which you mentioned, cost of living was still high even back then for that year. Now it's equally high for this year. Yeah. So,
now what has changed is that at that time, given that the startups were hyper funded,
right,
they would pay much more than they should ideally pay people of the similar caliber.
Right, of course, which was going to be my next question around that also, because you saw the start of when it was like you just explained, right, where you as founders were going out and meeting other founders, and it was a very cooperative sort of an environment.
Yeah.
But very quickly, I think between 2013 to 15, that just accelerated to this hyper-funded state, and then it was all-out war between in terms of hiring, poaching, throwing money at getting your team, throwing money at your problem, throwing money at your product.
Yeah, absolutely. And acquiring customers.
Exactly. So I think that's where it peaked, I would say, and then since then it's been on a decline.
Yeah.
So that was also part of. I mean, your story was basically part of that
journey. Yeah.
Absolutely. So tell us a little about. So once you started TaskBob, so obviously you ramped up very quickly, right? In terms of the segment.
Yeah.
So what was your early insights on what particular kind of things to focus on, and what was the early success, I would say, in what you got from customers?
So it has both positives and negatives to what we did. We thankfully scaled up pretty fast, and we got accelerated learning in some sense. On the flip side, scaling up too fast also had some negatives, and I'll come to that later. In terms of how it panned out, right? So initially, because we were in that entire ecosystem, we built a product, we got some very good feedback from the customers. That helped us to create a very strong word of mouth pretty soon. Helped us to create a brand around creating home services and getting reliable home services. That anyway being a big latent demand, it was easy for the customers and consumers to identify with this problem. So that helped us a lot. Then we subsequently we got our pre-series A round fairly early. That also helped us in scaling up pretty fast. And the first 1 year in 2015, we started off in November 2014, launched in December, and by April we had our pre-series A round. In the entire first year, it was all about scaling up pretty fast. We moved from 0 orders per day to around 700-800 orders per day in around 6, 7, 8 months.
Wow, that's
which was pretty good. And in the first 3, 4, 5 months, we were only in Powai, trying to talk to our customers as much as we could, fixing up some processes, understanding how to set up the operations. And then we scaled to whole of Bombay when we reached around 700-800 orders per day.
wow.
So that was more of the first year, and that is how I think the entire ecosystem held us, because we could get the team faster, we could talk to customers much better. We started off in an early adopter kind of a environment, because of which we got some early numbers, because of which we got our first round of funding, because of which we could scale faster.
Right.
So yeah, all that helped us.
Everything obviously fell in place, right? And it did. So that time itself was such that everyone seemed to sort of encourage things to happen.
Yeah.
Like you said, the investors were excessively enthusiastic, I would say.
Yeah.
Customers were happy to be early adopters, so things sort of fit in place for a lot of companies, right?
Yeah.
But obviously there were learnings which eventually led to you getting to a saturation point, and then you have realizing that there are much more difficulties also in the specific market. What do you think was a specific hindrance to your growth slowing down at some point, if it did, or did you what happened to that segment, and what did you learn from what you saw?
Got it. So there were definitely a lot of challenges in the whole market for home services, which we realized more in the second year. As I said, first year was all about scaling up, and we were, like many of the startups at that time, we were scaling up pretty aggressively, not looking at the profitability part of the business on a per consumer level, on a overall business level, and that was something that market made us to realize that we should focus on it. In end of 2015, I think Tiger had moved out of Flipkart.
Right.
And out of India, and at that time the entire market scenario changed,
right,
and the entire market, from moving towards scalability, moved towards focus on profitability. So then we started looking deeper into issues in terms of, are we making money on every customer, is our operational margin positive, from every order are we making enough money. Probably right now it's a small scale, so we won't be able to make a lot of money, but in the longer run, maybe after 3-4 years, will it be able to cover our marketing costs, our fixed costs, etc. So we started looking at these issues in the second year properly. And I think overall what we learned about this sector was that the sector isn't deep enough. The margins aren't very high. It's a thin margin kind of a space. What hurts more is that even Uber, for example, is a thin margin game. It's also a similar on-demand economy, right? But the frequency of usage per customer is very high.
Right.
So if you acquire a customer for, let's say, 400 rupees or 700 rupees or 500 rupees, Uber, let's say, makes around 30 rupees on every transaction. But then it has a very high chance of getting 10, 15, 20 orders from that customer in a very short period of time.
Right.
In our case, we had a similar kind of economics per order. But getting that customer to do 10 orders or 15 orders in home services was very difficult.
Yeah.
Getting him to book electrician, plumber, car cleaner, or car cleaning service, or a driver. Driver is still repeat, but again, it's not as high a repeat as how you book a taxi or how you eat, how often you eat food, right?
Right.
So making money from that same customer was not very easy. even though our quality of service was good, but home services didn't allow us to get a high repeat.
Great. So basically, you understood things like, like although people were really using the service, it just didn't make business sense for you guys unless you had the volumes.
Exactly, makes sense.
But would the volume solve the issue? Because you still have the problem where your customer value is significantly lower than your acquisition cost, right? So even more volumes, would that have solved the issue, or would you needed more volumes per customer?
Yeah.
So does that mean that you needed to expand the service bouquet, or does that mean, again, hindsight and all that, right? So I'm asking you to pick hindsight and
So there are, two ways to look at it and two ways to solve the problem. So the lifetime value of the customer that we were getting was lower because the repeat was low. So one way was to increase the lifetime value, and that we could have done by increasing the span of services.
Right.
But that would have reduced the quality.
Right.
Quality of offering, right?
Yeah.
And the other way was to reduce the cost of acquisition.
Right.
That could have come in if we would have increased the volume of customers and it would we would have been able to create such a strong brand that the brand and word of mouth would help us to acquire customers at a much lower
reduce
value. Like Just Dial, for example. Now it doesn't really need to do that much advertisement to acquire customers.
Correct.
So reach that scale that SEO will do your job.
Right. That's
very interesting. So obviously the sector hasn't gone away, and I want to talk to you more in detail about the specific things that happened when you decided to shut down the company. But the sector is still alive, and I would say trudging along. And you now have yourself also moved into a little formal version of the sector. It's sort of a larger service sector at large, right?
Absolutely.
So what is that like, and what do you do at Adonis now?
So I'll just give a brief about what Adonis is, because it's not a consumer brand, it's a B2B business. So Adonis Electronics is it's a service provider company. It used to be a subsidiary of Onida.
Right.
And it used to manage the service requests, installation requests for Onida a few years back. And then Onida carved Adonis out of the company. And now Adonis is a multi-brand service provider. So requests from Amazon, Vijay Sales, Onida, etc. are handled at the back end by Adonis. So how it works is, let's say you buy a TV from Amazon, and then Amazon will say that don't worry, we'll do your installation. But it's actually not Amazon which is doing the installation. Amazon will give it to Adonis. Adonis will get the services done.
Right.
And in return, Amazon will pay Adonis to do the servicing.
The service fee, right?
Yeah.
So this has always been around. This sort of industry has... So these are the things which I guess, as customers, you don't always think about who is this guy helping you out with. You still remember, like you said Amazon sells free service or free installation and so on, right? But obviously there's another entity behind all this. How has that sector done all this while, and what kind of outlook do you have for it?
So service industry, if you go deeper into it, right? So we were doing a B2C kind of a business. This is a B2B kind of a business, and I think the business model in Adonis is much stronger, and that's and I'll again come back to the challenges that we faced at TaskBob. It was into locking the customer and getting the number of repeats from the same customer versus the cost we were spending in acquiring the customer, right? In Adonis, it's with a business. So my cash flows are pretty much sorted, and they are dependent on Amazon giving me a continuous flow of revenues. So the business model is very different and stronger, and it serves service industry. Because from one customer getting I won't be getting 10 installations from the same Amazon customer, right? Same Amazon consumer. But from Amazon as a whole, I will get probably 100 installations in a week or a day. So the business model is different. The industry is the same, but this business model suits service industry much more.
Right, then the B2C direct model.
So basically you're moving the aggregation from your own platform into the e-commerce platform.
Yes, absolutely.
And they are basically then
acquiring the customer.
Right. That makes sense.
No, No, and that's always been around.
Yeah.
That's the thing. So I think what the sector was trying to disrupt was
trying to go direct to the consumer.
Exactly.
But and if that scale that doesn't work unless you have
a sizable scale, basically.
Right, yeah.
So it's a very capital intensive. TaskBob was a very capital intensive kind of a game.
Right.
Adonis is very different. It's a B2B kind of a business, and it's different in the sense you would not be focused on marketing. It would be more sales driven, like a typical B2B business.
Right. So very interesting. So I think that you've definitely seen some interesting sides of the same sector and the challenges therein. So I think we'll take a quick break, come back and talk about a little more of what you saw specifically happen at TaskBob.
Hey friend, so if you're listening to a podcast right now, you're probably some kind of a nerd at heart at least. So maybe, just maybe, you might like another podcast about nerds, by nerds, and for nerds.
It's called Geek Fruit, a community to unite estranged geeks from across India and later on the world. We talk about television, movies, science fiction, adventure, fantasy, etc. Anything nerdy, it's all here on Geek Fruit. You can catch a fresh episode every Monday,
and you can check us out on any of your favorite podcast apps, like my favorite podcast app, the IVM podcast app. Give me my money, IVM.
Good plug.
Happy listening, you nerds.
Hey, welcome back, guys. So Aseem, you were telling me about how, and the story goes, right, TaskBob was accelerating really fast. 2015, the famous year, which will go down in the Indian startup ecosystem.
Infamy, I guess, yeah. Infamy.
Just like you saw the 2008 in Lehman. So it was interesting that you've actually been personally involved in
multiple shutdowns.
One time it was someone else's company, and you were actually lucky to not be affected by it. So it would seem, because obviously everyone in Lehman in Powai, I think, transitioned into Nomura, right?
I think that was Asia,
much.
right? But they took over all the Asia operations.
Because we were the tech guys, right? We were not the investment bankers who were selling it to selling
the costly investment bankers.
So those are the guys who lost their jobs. But so, and then obviously then you had to see your own company get shut down, even though it was also on a very high growth track. So beyond what you told us about the sector and the challenges which you faced, as an entrepreneur, Amit, even like both of us, we've also shut down companies.
Right.
But it's usually because, hey, we ran out of money.
Pretty much.
So
it's always been that. Can't pay salaries, okay, time to shut.
Yeah, I mean, you figure out that something worked initially, then stopped working, and or rather, the scale it was at for I think for you and for with me in the case of, let's say, Point Shelf, was that it was a much smaller scale. The team size was really small. Yeah. There was little to no external money, so it wasn't that people were going to breathe down my neck saying, hey, return my money.
I didn't have to ask anybody about shutting down. I just okay, is this something that's going to work for me going forward? It's not. So, it's time to,
Exactly. And whatever little external money was, again, my co-founder and me, right? So it was pretty much ourselves. So, but it's different for a venture funded company, especially one which got significantly funded and grew to such a large scale, both in terms of customers as well as your team. So how was that like, and how do you go through that entire phase, if you could share some insight?
Absolutely. So it was pretty intense, and you must have experienced it as well. Shutdowns are tough,
right?
But thankfully we could prepare well for it. Because I'll give you a small background here. So in 2015, right? So when we were on the upward trajectory as well, during December that year, 2015, there was a time when we were getting the funds from the next round were taking some time to come in. So we did have a rough patch around at that time. We had some liabilities, crores of liabilities, and we couldn't pay salaries to our employees at that time. for
Even
1
though
month.
you had committed
Yeah,
funds.
we had committed funds, but it was still taking some time. And then we couldn't pay salaries, so it was really tough. It was stressful time. For 1 month, we couldn't pay salaries. Some of our employees actually put in some loan, and then we could pay our service providers and our team. So we had that sort of experience just the previous year. So in 2016, then when we got the funds, then we started moving in that direction where we wanted to focus the company forward. And then we started moving towards profitability in the second year, again scalability. We did multiple things in the second year. But then finally, towards the end of second year, when we decided to shut down the company, given that we had that experience, we prepared for it much better. So this time around, we decided that, let's say, when XYZ rupees would be left in the bank,
Right.
even at that time itself, we will take a call instead of going
All
till
the
the
way
very
to the very
last
end.
moment.
Right.
We would then probably first help our employees
Right.
because that is the most important thing. We would help them get outplaced, and we did that. So we decided to shut down in around November actually, and eventually we shut down in March for customers, but we had pre-decided in November.
Okay.
For the next 1.5 months, we extensively helped all our employees to get outplaced.
Okay.
There were only some 5-7 people left who were managing the operations.
Okay.
We shut down like basic costs like marketing costs, reduced the operations to 1 or 2 people only. And then the sales guy in the team, he started selling the assets so that we could get more funds. So the team was still working, but we practically outplaced like 95% of the team in the next 1.5 months.
Wow. How large was the team?
At that point, it was around 50 odd people. In that entire year, we had to lay off around 40-45 people.
Wow.
So at that point, then we outplaced around 45 people, and we were around 7-8 who were still working. So first step was outplacing employees. Second step was paying off all the vendors. So then we paid off all the vendors because last time we had a experience of having 5 crores of liabilities.
Right.
Wow.
So we ensured that this time we don't want that mess. So we paid off the vendors. So on books, we were now pretty healthy. Then we gave a notice to the service providers because
Even
next in line,
yeah.
it was them because their lives would have gotten much more affected than anyone else, right? So we gave them a 1 month's notice. Then they were still working at that time and offering services because that would help them get some revenue for themselves and some salary for themselves, right? So then we gave them a notice. And then finally, we told the customers. At that time also, we had some subscriptions running for some customers. So we paid that money back to the customers also.
Okay.
And then finally, in around February, and we then sent out an email to the customers. At the same time, given that in the past 2 years, we had curated a list of very good service providers. So as a good gesture, we also shared that list with the customers that even if TASBOB is not around, you can still get services done from these gentlemen.
Right.
That would help the customers also and the service providers also.
Right.
So we did that, and then finally that's when we shut down.
That's a very clean shutdown, actually. I mean, like compared to a lot of the other messes you hear about.
Exactly.
Yeah.
That seems like a very kind of clean way to kind of go about doing it. Impressive, man.
Yeah, but again, do you think how much of this was because you also had the luxury of the funds to manage all of this, and hence the time, right?
Yeah.
Like you said, obviously your experience the year before sort of catalyzed it, or made you put your foot down, because I think the biggest challenge for any entrepreneur or founder is like is saying that or showing that you've given up, right? That's the biggest thing, because your entire character is to not give up.
Exactly.
Absolutely. No, I completely agree. And it was actually, to be honest, had we not, in the first year we were like that.
Yeah.
We were actually not giving up till the last moment, and we were fighting it out with how can we get funds faster, and we were doing all kinds of things to do that.
Right.
So the first year was that.
Right.
The second year we took a conscious call because we ourselves could not give up, and that was fine. But behind us, we had the responsibility to look after 50 other employees.
Right.
That was very important for us because somewhere when you have that bigger size and all those people, not just the employees, even the service providers, their livelihoods are dependent on you.
Right.
So in the first year, we were actually seeing that every day, because the call center employees, right, their monthly salary is extremely important for them, because their lives are centered around that 20,000 or 15,000 that you pay them.
Right.
And we could see when we were not giving that affected a lot of lives in a much worse way than it could have. It wouldn't have affected us that much. We would probably have gotten help from relatives, families, etc. But for such people, it's going to be very difficult, right? So we went through that, and that's why in the second year we consciously made a call that we'll not be affecting the lives of 50 employees than probably just for not giving up and not taking a prudent call.
It's basically putting them before yourself, right? In a lot of ways. As a founder, you're always dedicated and driven, and not giving up as your attitude could be that.
Sometimes delusional, right? I mean, like, you're just like, we're going to make this work no matter what. It's going to happen. We're going to make it work.
Yeah, but the no matter what should be with no matter what for me, and not always no matter what for everyone else.
Exactly. That implies a certain amount of reasonability in founders, which is not always there, right?
Right. No, but coming back to the fact that you could do this, right? The fact that you consciously took this decision also from the learnings you had in terms of how you had to raise money and specifically to that extent, right? I think what happens with venture funding is that venture funding also makes you a little reckless at times. Because the entire business model of venture funding is that you go spend the money. Not, hey, save money on the side for you can say severance packages and blah blah blah. And VCs actually don't like that. I mean, it's not in their best interest that you do that, right? Even if it's a small percentage of the money. So, how did that all work out? And what do you think? Were you reckless initially, and then hence had to really go back to your VCs and say that this is not how you do it? What do you think was?
To be honest, in terms of being reckless, in hindsight, if I look at how I would do the business again if I were given a chance, yes, we could have been more cautious in the first year. But again, this industry, to organize the market, to scale faster, to capture the market faster, one needs to spend some money, though we could have been more careful. We tried some very costly experiments, which you get the liberty to do because of venture funding, as you rightly said.
Right.
In hindsight, we could have avoided some of those experiments and could have been more careful in doing costly experiments. But in the second year, our mindset shifted pretty much from being
hyper growth
to hyper focusing on profitability. We took several steps towards moving towards profitability, and we eventually also got to some operational profitability. But then in the longer run, it was not making a lot of sense unless we had a lot of funds to back us to build this business, because the economics of this business weren't that strong. And while talking to our investors about the entire philosophy of how we grew the business in the first year versus second year, they also saw what we were doing and what change we went through. So finally, when we were shutting down the company, they were also on board in terms of the steps that we took.
Right. No, so while, I mean, that is also the risk a venture fund takes, right?
Absolutely.
The whole bet that they did was also because it was a bet, and it was there was a hope that this would work out and the money would lead to some outcome. And while it's good to hear that at least the people who were who put in so much hard work in your team could get safely adjusted in the rest of the ecosystem. I think that was also a time when everything was sort of on fire all around, right?
Absolutely. 2 months later, I think Stazilla shut down, and it was not a nice shutdown. And
I think even TinyOwl was around that time, no? When they had all
just
of their
before
problems.
that.
So that was The opposite of a clean shutdown.
Exactly, right? So again, there were, for whatever those reasons were, maybe if we ever talk to those guys, we'll know if they share. But I think what you did was, again, right, basis the fact that you and your team had the sensibility to do it this way. Venture funds who you had raised quite a lot of money from also saw that, yes, the bet wasn't, paying off in the way they thought it would. Given the sector is still fairly new or underserved even now, right? I mean, you had competitors as well.
Yeah.
What were they doing differently or right or better, or, what's your take on how this story will play out?
So overall, at a very overall broad level, I still believe the margins in this space are very low. And one can build a business only when he is at a very big scale, because then the cost of customer acquisition will be fairly low. To reach to that scale, the company will need to attract a lot of funds. It will need to do that, and where some of the players who are still alive, what they did well was they could attract a lot of funding to sail through this lean patch in terms of startup ecosystem when the fundings were not coming in 2015, 2016 particularly, and 2017, right? So to evade that entire dry spell of no funding, these companies needed hyper funding early on, which they managed to do, and then they sailed through it. A lot of the startups couldn't raise money that we could, and they died off in 2015 itself. Some of them who were around at our stage with the similar kind of funding that we had, some of them shut down, some of them got acquired somewhere. Only 2 big startups are alive right now. And one Urban Clap and second is House Joy, and both of them could secure around 40 million-ish funding at that time. So
right, which allowed them to
sail through this lean patch.
And obviously they also had to dial down their growth spending and focus on profitability.
Absolutely.
Since you mentioned the acquisition path, right? Again, that's something which we've heard some cases of acquisitions happening. In fact, most of the cases you hear are the cases where they happen on the downturn for that company. Very few in India have actually been upside acquisitions. And they've, I think, Freecharge, Citrus, hardly any which have been really upside sort of acquisitions, right?
True.
What was your take on that path, and what kind of challenges did you face? Because obviously you would have explored that opportunity.
Yeah. So when we started outplacing our employees, right? So at that time, in the next 3-4 months, when we were still operating, at that time we were looking at some options, and we were closely looking at a few options which could have been interesting, but those weren't really very lucrative from the investor's point of view in some cases. In some cases, the ideologies did not match. So we did try a few of them. Somehow we couldn't strike a deal and didn't go through with the entire journey. We were in last stages with 2-3 of them. Okay. But then finally it didn't work out. We did try, of course, because it makes sense, right? It makes financial sense also, rather than shutting down something.
You can salvage the business you want to salvage the business you want.
But how much, and since you were in the seat when this was happening, how much of this is really, and for others to also understand this, how much of this is driven by, like you said, ideology not mismatching, and also from what you as a founder versus what the investors who own a sizable chunk of the company, how much of it is the dynamics of that? Because when you shut down, basically everyone shuts down. Yeah. Versus when you get acquired, there is something, right? I mean, whatever semblance of it will be retained, or there'll be some exit, as they say. So how much of it, in your case or in general, is driven by for your founding team decision versus venture decision versus the dynamics of
So see, it's always negotiation that happens in between the founders and the investors. It's never a clear founders only or investors only, because finally you are in a partnership.
Correct.
And you are building the business together.
Correct.
So in some cases you would see an offer which probably the investors like more, and the founders are not on the same page. And in some other cases it's the other way around. There's no clear answer there, but at least the investors, in my opinion, have more to, it's more at stake for them, because they have actually lost sizable amount of money.
Right.
In terms of founders, yes, they have lost their business, but they still got some learning out of it. They went through the entire experience. So for investors, it's more of a financial loss, but it's one of their portfolio companies. So that's the investors' side of the story.
Mm-hmm.
For founders, it is that one company that they thought that they'll make it big.
Mm-hmm.
So it's a fine balance. I wouldn't say that it's only founders or only investors. In our case also, in some cases, it was our decision to not agree with some of the offers. In some cases, it was investors' decision to not agree with some of the offers.
Right. But you obviously did look at all of these options, and that's
absolutely.
what you, as your duty to do
it
that.
makes sense, and everybody should look at that, obviously.
Yeah. But again, it comes down to the negotiation and the terms, right?
Exactly.
I think we've had a few folks on the show who have, even investors, who've spoken about how terms also matter quite a bit.
Absolutely.
When you sign up to have a partner like that on board. Because you have to prepare for the worst in like this, as well as potentially the upside which they would have gotten.
Yeah.
But coming back to now, obviously, as like you said, this was first company which you started maybe was a little smaller scale, which you pivoted out.
Yeah.
This one was obviously huge, so much learning. Which went through a very long and, I would say, formal sort of a shutdown.
Yeah.
And obviously it was also loved by customers. I know, the sector also was warming up. Mm-hmm. You guys were doing really well. Personally for you, what made you not start up again, or are you still thinking of doing that at some point once you know a little bit more?
Only one reason: financial risk.
Right, of course.
So in the two startups that I had, I practically lost almost all my earnings.
Right.
We also did not pay ourselves market salaries when we were building a TaskBob.
Right.
First year because you are building it, and second year we were focusing on profitability, and overall company's health wasn't too strong. So I cannot draw market salary.
Typically, usually how it is, right?
Yeah.
I mean, to be honest. Most of us, while we are driven, we are also fairly humble and poor. Of course, again, in that 2015 hype cycle, we have seen people have paid themselves obnoxious amounts of money.
Yeah, absolutely.
In fact, those have been reasons why they've shut down also. But those are a different breed of founders, I would say, who are able to, consciously do that without feeling the guilt of it.
It's tough, man. I mean, like, trying to figure out what your own compensation should be is one of the toughest questions in this thing. I mean, like, it's just
So that way it's easier when you're asking, going for getting a job, right? That's when you can.
You ask for what you want, then, right? I mean, like, what people, you know what the market is for what you do, and I mean, like, you just ask for that, right? But in this case, you have to kind of. You have to balance the idea of like, the payroll component cannot become more than a certain percentage of the overall business expense. Yeah. And if you start adding your own market salary to that, then at that point in time it gets a little wonky. It's really tough, man.
It's tough, and secondly, if you start paying yourself market salaries when you are starting companies, right, then acquiring a team and building a team,
you have to pay them market salaries.
Yeah, exactly. And building a very strong team at lower than market salaries is very difficult, because how will I ask a person who could be getting, let's say, 50-60 lakhs to come join me at 15 lakhs? I cannot. But if I myself am doing it, then it
becomes this. And they also, I mean, like, you do the option based salaries, and you kind of like, make stuff happen there. But it is, but that's how it happens. That's how you have to do it. That's why I think options are so particularly powerful, right?
And of course, I mean, that's also a signal of the kind of culture you want to build.
Exactly.
So it starts from the top, and you have to set the standards of that in order to acquire the right talent as well.
Absolutely.
Since you mentioned options, though, again, it's interesting to note how does, obviously when you shut down the company, they all no longer exist. But what kind of feedback did you get from the team and everyone? Obviously, because if it's a shutdown, beyond the salary component that you were paying them, again, an acquisition would have turned those options into something else. So, what kind of feedback? How did your team take it? And do you have any stories to tell about how the team sort of moved on post Asbab?
Yeah. So even though we thankfully could create a very strong team and at much lower than market salaries, and we did give them sizable options, but I think once it's more of when you are interviewing people and when you are giving them an offer, that they look very deeply into options and how they are going to be used and how successful it's going to be, etc., etc. Once they join the company and they are working on the problems throughout that journey, it's not driven by that at their background. So it's more about, okay, I am in this problem, I have to deal with this problem, and this is going somewhere. I'm loving creating that company and solving these problems, and so on and so forth, right? So when we were shutting it down, I didn't see most of the employees even thinking about options or shit, we did not take market salaries for 2 years, we lost this time. Most of the employees, almost all of us, including us, we came out saying, come on, hey, we learnt a lot. It was a wonderful experience. Nobody thought that, I could have taken a market salary, not taken those options, and my options are now vested, but they are of no use, etc., etc.
So you built a good team.
Thankfully.
Yeah. So, like you said, obviously, right now you're not starting up, but would you do it again? And
most probably yes, because once an entrepreneur, always an entrepreneur.
Bit by the bug.
Yeah, exactly. Maybe.
When the time comes, but
and save up some money.
You
have to save up money to lose it all again, right? So
and then save up and then so that's
I think that's the founder cycle that we go through in our lives. That save up some money, lose it all again, or hopefully save up enough to never have to work again.
In some cases, kind of is either or, right?
Yeah.
You hit your company and then you never have to work again. You don't hit your company, then you lose it all.
So you never know. Maybe
0
when
or 1,
we
basically.
Yes, like Shunya One. That's what it is. That's what it all about.
Yeah, see, that was intentional. That's why we titled the show like that.
Exactly. I think that's all the best to you, Aseem. I think you're doing a great job here now that you're also, back in the sector. And I'm sure you'll come up with something which you want to do and make your mark once again. And obviously...
and thanks for talking so openly about all of the stuff around the shutdown.
Absolutely. I think there's so much to learn from how things happen in the startup business. And let's keep telling more stories. So
absolutely.
Thanks a lot for having me. Thanks a lot. It was a wonderful experience.
It was great having you.
Absolutely. Let's hope maybe you'll come back and you never know, you'll be a founder again and we'll talk about your experiences then.
Right.
Absolutely.
And, let me do the little bit of wrap-up stuff, guys. Go to the ivmpodcast.com/Shunya One page where you can sign up for the Slack channel. Press the button over there, request the invite, and we'll send an invitation to you. Also, 5-star reviews on iTunes are really important, and please do that for us.
All right. So remember, you can find Aseem on Twitter at
Aseem Khare.
Aseem Khare. And that's it from our show. Thank you.
Good evening, ladies and gentlemen. This is your captain speaking. Sorry to say, but there's been a slight delay due to the apocalypse having suddenly begun. As you can see, there's death, destruction, and chaos taking place all around us. But don't you worry, food and drinks will be served shortly, and I would recommend checking out IVM Podcasts to get some of your favorite Indian podcasts. We'll keep you going till this whole thing blows over. Thank you.